Right now, if you look at silver year to date, it's actually performed just a little bit better than gold. Um, well, basically the same,
Hmm.
but a little bit better according to Bloomberg. Um, of course, it's come down, it ran up sharply at the second half of, in May and beginning of June. So it's come down from there. No, I think silver is very attractive right now, both as the physical and as the equities.
Precious metals have had a remarkable year, with August continuing the bullish trend. Silver, in particular, has outperformed gold year to date, while gold is nearing levels that could mark a new all-time high. China's strong demand for silver has driven domestic prices above international levels. A trend Bloomberg reports may lead to increased imports to the East Asian nation in the coming weeks. Adrian Day, founder of Adrian Day Asset Management, sees silver as particularly appealing right now. He points out significant differences between gold and silver, especially in their use in solar panels. Day predicts that the ongoing growth in solar panel installations will drive further silver demand, especially considering the 10-year lifespan of these panels. Bloomberg recently reported that China's silver imports reached a 3-year high of 390 tons in December and 340 tons in April, well above the 5-year average of 310 tons per month. On the supply side, Day explains that only 30% of silver production comes from primary silver mines, with most silver now being a byproduct of lead and zinc mining. This makes silver supply largely unresponsive to price changes, as miners are unlikely to adjust production based on silver prices alone. Global silver mine production is expected to rebound in 2024, with a projected growth rate of 4.1%, reaching 916.1 million ounces. This increase will be driven primarily by the resumption of operations that were temporarily halted in 2023. Despite these differences in supply and demand, silver tends to move in tandem with gold in response to monetary factors. In this way, Day suggests that silver offers the best of both worlds. Adrian Day discusses the significant differences between gold and silver, particularly on the demand side. He emphasizes that the growing demand for solar panels is likely to continue, and since these panels require silver, this will be a substantial driver in the silver market. Additionally, solar panels have a lifespan of around 10 years, meaning they will need to be replaced, further increasing silver demand. On the supply side, the situation is quite different. 30 years ago, the majority of silver production came from primary silver mines. Today, however, only 30% of global silver production is from these mines, with most silver now being a byproduct of lead or zinc mining, not gold. This is crucial because it means that silver supply does not easily respond to changes in demand or price. For instance, if the price of silver were to rise to $30 per ounce, a lead miner in Bolivia wouldn't necessarily increase lead production just because silver is a byproduct. Similarly, if silver prices were to drop, zinc mining wouldn't halt due to the small percentage of silver involved. This unresponsive supply is why silver can experience dramatic price swings, both upward and downward, unlike gold. Despite these differences, silver often moves in tandem with gold in response to monetary factors, offering a best of both worlds scenario. Year to date, silver has slightly outperformed gold, making it an attractive option for both physical assets and equities. Adrian Day mentions that central banks in Uzbekistan, China, or Germany prefer physical gold over other assets, including uranium or mining stocks like Newmont or Barrick. According to him, these investors seek to protect their assets and turn to gold, a traditional store of value, in China rather than equities or cryptocurrencies. The World Gold Council's second quarter of 2024 gold demand trends report reveals that total global gold demand increased 4% year-on-year to 1,258 tons. Total demand was supported by healthy OTC transactions, up a notable 53% year-on-year at 329 tons. Moreover, Adrian underscores that Western investors have mostly been net sellers of gold this year, but see a recent shift with large OTC trades in London likely by wealthy individuals or institutions. Despite this, retail investors haven't rushed into gold, signaling a gradual shift in sentiment. Adrian Day suggests that they need to look at who has been buying gold and why. Over the last 18 months and throughout most of this year, the leading buyers of gold have been central banks. These banks are diversifying their assets away from the dollar to avoid the risks associated with its weaponization. Gold, being a traditional central bank asset, is a natural choice for them. Whether it's the central banks of Uzbekistan, China, Germany, or any other country, they are opting to buy physical gold. They aren't going to invest in something like uranium for their reserves. Even though uranium has performed well, but that's another discussion. Their focus is almost exclusively on gold, rather than on mining stocks like Newmont or Barrick, as they aim to mitigate the risks tied to the dollar. Recently, they've started to see some movement from Western investors as well. Up until very recently, investors in North America and Europe have been consistent net sellers of gold throughout the year. However, in the last 4 to 6 weeks, there have been some significant over-the-counter trades in London. While these trades aren't reported individually, the aggregate data suggests that a small number of very wealthy families and possibly some institutions are looking to get into gold. Despite this, there hasn't been a widespread rush by individual or retail investors to buy gold. Coin dealers Adrian Day spoken to have noticed a slight shift, but nothing substantial. Earlier this year, many were actually seeing more people wanting to sell their gold rather than buy it. In terms of gold ETFs like GLD, while they've seen a bit more inflow over the past month, it's still balanced between inflows and outflows. Up until August, it was mostly consistent selling, 3 or 4 days of selling for every 1 day of buying. But now that's starting to shift. They're seeing more buying, maybe 3 days of buying for every 2 days of outflows. The current macroeconomic environment in the US and North America doesn't seem particularly favorable for buying physical gold. Yes, the dollar has weakened, but interest rates are still high, inflation appears to be low and declining, and the economy remains strong. In such an environment, gold isn't the asset of choice. However, this seems to be changing as more people begin to notice the economy slowing, with unemployment rising for 4 consecutive months in the US. The key event here is Jerome Powell's recent speech at Jackson Hole, where he indicated that it's time to shift policy. The expectation is that the Fed will cut interest rates next month, and typically, when the Fed first cuts rates, gold tends to gain traction. Day believes that in the next month, they'll see more individuals and retail investors starting to move into the gold space. Despite recent fluctuations, the long-term outlook for silver remains promising. Its industrial uses and historical correlation with gold are expected to drive future growth. While a long-standing projection suggests silver could eventually reach $50 per ounce, the exact timing of this milestone remains uncertain. How do you think the relationship between silver and gold will influence investment strategies in the coming years? Share your thoughts in the comments below. If you found this video informative, please support our channel by subscribing and turning on notifications to stay updated with our latest content. See you in the next video.